Hello? Wait, why am I self-muted? Oh, where did he go? Mike? Hello?
Can you hear me okay?
Oh, yeah, I can hear you.
Okay, good.
Okay. Okay, just unmuted. Okay, we're all in the staff as panelists.
Okay.
So that should be good.
Let me share my screen here. Hold on.
Oh, wait, I just changed you as a presenter. Mike. Yes. Just gonna turn my thing off. Oh, need- Okay, yeah, I can see it. Webcams.
Everything good?
Yes. Okay. Okay, so I think we should be good to go. Once people start joining, which hopefully people join, I guess I could probably go on mute at 2 o'clock, right?
Yeah, that's fine.
Okay.
You guys can't hear the lawnmower in the background, can you?
I don't think so.
Okay, cool. Cool. Perfect timing for someone to be doing that.
Oh, yes. Who was it? Somebody was telling me that with the explosion of pickleball and the interest in the sport, and with so many people working from home now, I guess the noise associated with pickleball, people living by these courts are complaining that they're trying to work.
Oh, yeah.
I can
No.
see it. I mean, that paddle makes a loud noise.
Yeah,
That's so funny.
yeah. It's not the lawnmower, it's the pickleball game.
Yeah. Yeah.
Okay. I can see like 22 registered. Just say.
Cassie, when I left, it looked like the moving process was going to begin shortly. Is that?
Yeah. I've been cleaning out my desk and it's quite the task. Yeah, stuff's just piled up. But yeah, I think next week that's kind of, oh, I think someone's here. Yeah. I will unmute everyone.
Looks like we have a few folks joining. Thank you for participating. We'll begin here in about 2 or 3 minutes.
All right. Well, folks, it's 3 o'clock. As people come in, we will, just have them join in the conversation as we're continuing through. But thank you so much for taking time in your afternoon. My name is Jack Leaves, Mike Hegwood. We are from AMA Insurance. As Dr. Lazarus said in her email, we cover you folks through your group long-term disability insurance package. And this conversation is kind of just to take a look at conversion from that group package into individual disability insurance, what to look for in those conversion packages, and just the different types of perks that you may find with some folks and not necessarily others. If there are any questions throughout the course of the presentation, please throw them in the chat within the little panel that should be popped up on your screens. And we will get to them either if they're pertinent questions to what we're talking about in that moment, we'll talk through them as they come in, or we will take time at the end for Q&A. Mike, I'll hand it over to you.
Thanks, Jack, and thanks everyone for participating. First thing we're going to do is we're going to take off our cameras here so you can actually see the presentation, and we'll turn the cameras back on at the end. And as Jack said, along the way, if you have questions, please throw them into the chat. I think everybody's on mute at this point in time. We weren't sure how big the group was going to be. So we'll try to answer questions as they pop up, and we'll certainly answer them all at the end of the conversation. So I'm just going to jump in here. Let me first turn the camera off. Okay. So as Jack said, LSU has made a decision to use the MedPlus Advantage program. It's a group disability program that you all have been covered by for 4 years at medical school. And so through that process and through years of providing this coverage, we have typically gotten a number of questions. And so this presentation is really designed around questions about disability insurance just in general, and about the options you have available as a graduating medical student. And if nothing else, what we want to do in this session is to give you some things to think about, consider, in particular, some things to look for. And then the other big question we always get is why now? Why should I consider disability insurance now? So we're just going to give you some things to think about as we go through this. So as Jack said, my name is Mike Hegwood. I've been with the AMA for 17 years and have been doing this with groups all across the country. So here's kind of what we're hoping to accomplish today, and you'll see the lion's share of this is really about trying to provide you with insight and education around the world of disability insurance. And so we'll talk a little bit about the dilemma that young physicians tend to be in as it pertains to this. And again, as I mentioned, what to look for, why now, and then we'll look at just a quick overview of the different plans available so you can kind of compare and contrast what's out in the marketplace. We'll talk more specifically about what conversion coverage is, what it means to you, and then we'll give you just a brief overview of the plan you have access to through LSU called the AMA sponsored plan. So real quickly here, just some background. Most physicians at this stage in their career as medical students have had some sort of, or do have some sort of group insurance. Unfortunately, that coverage typically ends as you complete either your education or your training and moving into practice. The coverage that you have as a participant in a group plan is not portable, which means you can't take it with you. It's not always tailored specifically to physicians. However, it is less expensive than what you might purchase out on the individual market. The challenge comes in that the plans themselves can be somewhat confusing. There's a lot of moving pieces and parts, and there's a lot of different products that you can select from. There's really no general quote engine out in the market, so kind of comparing and contrasting these creates more of a complicated purchase decision. However, from a survey of top disability insurance agents across the country, we were not part of that, but according to all these agents, nearly 70% or a little over 70% of physicians actually purchase an individual disability plan within their first year of practice or even before that while they're still in training. And most purchase this type of coverage because it is portable. It does create some favored tax positioning for you. The contract language tends to be a bit more robust, and it can provide some added layers of protection on top of what you might already have in an employer type of setting. So that's sort of the lay of the land that we typically see. in the market as we're speaking with young physicians. Now, let me flip this a little bit and let's talk about the dilemma that we feel like many of you might be in. And that is this: the financial risk of some sort of illness or injury, which would create some sort of disabling event, is typically highest when you're young. And that's because the gap of what you've accumulated with financial assets and what your obligations are tend to be at its highest point. Meanwhile, the resources that many of you might have can be tight at this age. You might be saddled with student loans and or limited income. And as I mentioned on the prior slide, the market is pretty competitive. There are a lot of plans out there which can cause some confusion and make it a bit more difficult to select a plan that may make the most sense for you. It's also hard to find trusted sources. A lot of individual insurance agents receive a fairly healthy commission on these types of sales, and so they're going to push the plans that they have access to. There's a lot of good, very reputable agents out in the marketplace, but sometimes finding which is which can be a difficult process. And yet at the end of all this, the decision or the need rather for disability insurance at this age remains really strong. It's something that most young physicians should have, and as you saw on the last slide, most young physicians do have at a very early age. So let me shift gears now and give you some things just to consider as you explore options with disability insurance, whether it's through us or someone else. I think it's important for you to make informed decisions. And so we want to give you some things just to consider and to look for. So the first thing that I would encourage you to look for and to understand is the definition of disability. It's a very, very important and probably one of the most important provisions in any disability contract because it determines when a benefit is or is not paid. And so let's go through a couple different examples here. One of the more common definitions is what's referred to as an any occupation definition. You'll hear it in the marketplace referred to as any OC, any occupation. And in this kind of a definition, in the event that you became disabled, and let's say you could not perform your duties as a physician, but you were still able to work in another occupation that you might be qualified for based on your education, the definition would not trigger a benefit, okay? So it's only going to trigger a benefit if you are unable to work in any other qualified occupation. Typically, we don't see a lot of physicians selecting this type of definition, but they are out there. The next one we see a lot is what's referred to as a modified own occupation definition. And the easiest way I can explain this to you is that it does cover you in your specialty. It will cover you for that specialty in the event that you do not work in it. In other words, let's say you became disabled, you're a surgeon, and you become disabled and can no longer perform surgery, but you can go back and teach at the medical school. So you are still working, but you are not working in your specialty as a surgeon. These types of contracts are designed to cover the gap that might be created in terms of what you were making as a surgeon and what you are making now. So it doesn't pay out full benefits, it pays out the benefit needed to help close the gap to keep your income whole. And then the last one that we see in the marketplace, which is one of the more popular ones certainly, is the true own or true own occupation definition. And this is slightly different than the modified ONOC in that it will pay you benefits if you're disabled, even if you decide to return to work in another medical occupation. So again, back to my example, you're a surgeon, you become disabled, can no longer perform surgery, but you can go back and let's say be a family practice physician. And so this type of definition will trigger full payouts even if you are returning to work, and it will be on top of the income that you earn in your role as a family practice physician in my example. So there's different types of definitions, and as you might imagine, they have different cost elements associated to them. So in any occupation is going to be the least expensive, modified somewhere in the middle, and the most expensive is going to be the true own occupation. So it's important, in our opinion, to understand what it is you have, knowing that, especially as you think about coordinating some benefits between what you might be receiving from your group or your institution, your employer, and what you might purchase on your own. A couple other things that we would encourage you to consider. We get a lot of questions on these types of features that are associated with a disability plan. Let me give you 4 examples of what I mean. The first is what's referred to as a future increase option. You'll see acronyms in the market like FIO or a future benefit increase, FBI, an FBO, future benefit option. They're all the same things in most instances. And what they allow you to do is after you've purchased your disability plan and in a few years later, let's say your income increases, you don't have to go back and buy a new disability plan to cover that additional income. The contract that you have, if it has this provision in it, would allow you to exercise that feature and purchase more coverage without going through all of the underwriting requirements that would normally be associated with the new purchase. So no additional health questions, no medical exams, no blood or urine. It's a wonderful feature, we believe, for a young physician that allows you to grow into a plan over a period of time as your income might increase without having to go through all the hoops of purchasing a second and a third plan. Another one that's very popular in the market, we see this in a lot of different contracts with a lot of different carriers, a student loan payoff provision. And the intent here is to pay above and beyond the normal benefit that you might receive. And so in the event that you become disabled, and let's say you're permanently and totally disabled per the definition of the contract, this type of provision would pay up to a threshold. So in this example, maybe up to $200,000. It might be lower, might be higher, depending on the contract, but it would help you pay off or completely pay off your educational debt. And it wouldn't take away from the overall benefit that you might otherwise be receiving. So it's an additive, another benefit on top of the core benefit. A third one that we think is very, very important, especially for younger physicians, is a cost of living adjustment or a COLA rider. And what this does for you is in the event that you become disabled, let's say you purchase a disability contract at the age of 32 and something happens and at the age of 40, you become severely disabled. Well, you might need that benefit from the age of 40 all the way to your retirement age. And if that benefit doesn't adjust and increase with the cost of living, the value of the benefit obviously is eroded very quickly. And so a lot of these plans will have options that allow you to weave this in. There is a cost component, but we believe it's a very important consideration, especially for younger physicians. And in a similar fashion, there are catastrophic riders, or you'll hear of them referred to in the market as a CAT rider. The idea here is to pay, kind of like the student loan provision, an additional benefit. So in the event you become catastrophically disabled and can't perform, let's say, 2 of the daily activities of living, this type of provision would pay an additional benefit above and beyond what your contract would normally pay in the event of a disabling situation. So these are just some things to consider as you explore options on the disability contracts you might be considering. Now, here are some other things that we would encourage you to think about. They're not necessarily features per se of the contract or the provisions in the contract, but I would encourage you to think about them as you consider different products in the market. So the first and a very important one, again, for a younger physician is portability. So typically when your education, when your training or your employment ends, the coverage that you might be receiving through that group is typically going to end as well. In some cases, you can convert that coverage and take it with you, but in most cases, what it is you're being provided as an employee is going to end when you leave that practice. So that's certainly a consideration. On the other hand, an individual plan that you would purchase on your own is portable. So whether you change careers one time or 10 times, that plan will stay with you as long as you continue to pay the premium. So understanding what is and isn't portable is important, especially when it comes to planning. The other thing to consider is the benefit amount. And the benefit amount is typically articulated in one of two ways, either as a percent of income or as a specific amount. So in the slide that you're seeing, you're going to see 60% as the percent of income, or you'll see $10,000 as a specified amount. Typically, group plans use a percent of income because then they can offer the same sort of contract language to the group. The benefit then varies slightly by your specific salary or your specific income. An individual plan is more likely to have a specified benefit amount. It's also important to understand how long any benefit might be paid. So there are plans out there that cost a lot less, but they may only pay a benefit for 5 years or for 10 years. Most plans that we see in the physician marketplace will pay until age 65 or until the Social Security normal retirement age, SSNRA. And so for many of you, that might be 67 or 68, depending on where you kind of fall on that spectrum. So those are considerations to kind of think about as it pertains to benefits. The other important one is the tax implication. Not so much of what you're paying in terms of premium, but the tax implication of any benefit that you might be paid if you were to become disabled. And this is important because if you don't understand this and you don't understand how your benefit might be paid, you might not have enough coverage in place to replace your income. So the general rule of thumb is this: if the employer is paying the premium, then the benefit that you might receive in the event of a disabling situation is likely to be taxed. So back in my example, 60% income, let's say that equates to a benefit paid out of $8,000. Well, that $8,000 that you're going to receive is going to be a taxable benefit. So there's a net result there. However, if you pay the premium, which is the case in most individual plans, if you pay the premium, any benefit that you would receive would not be taxed. And again, it's simply not a right and a wrong way to do it. It's just simply important to understand how it works so you can plan for the right amount of coverage for your particular situation. The other thing that I would encourage you to think about is the pricing. And when I say pricing, I'm not referring to simply the premium. I'm encouraging you to think about the different factors that go into how an insurance product is priced. For instance, there's typically two types of rating structures that you'll see in the disability market. One is what is referred to as a level premium plan. The other is a step rated plan, which increases over a period of time. I'll show you an example of that here in just a second. The other things to consider about the pricing components: does the plan offer some sort of discount or a premium credit? And then does the plan vary rates by occupation or gender? So you might see, for instance, an illustration from one of your peers or presented to one of your peers or someone else in the market that was specifically for them. But if you're of different gender and a different occupation, your rate could be comparably different. So understanding what's driving that pricing, in my opinion, is important to help you make a more informed decision. So here's kind of a quick visual illustration of the difference in terms of the rating structure. So again, a level rate, you're going to get the peace of mind of knowing that what that rate is at age 40 is going to be the same at age 65 or 64. So you know what it is, you can plan to it. Meanwhile, a step rated plan is really more indicative of the true cost of insurance. Insurance is generally less expensive when you're young and healthy, and becomes a little more expensive as you get older and possibly not as in good a health. And so as you see this illustration, what it basically says is, you can get the peace of mind of a level rate, a lot of people do, or you can go with the step rate. The difference here is if you elect to purchase a level rated policy, you are basically subsidizing the cost for older physicians. Okay, so you'll pay more when you're younger than what the true cost of insurance really is, and you'll pay less when you're older. In our opinion, there's not a right and a wrong way. In fact, we offer both. It's simply a decision, and each physician is in their own unique situation, and we just want you to make an informed decision as to which of these may work the best for you. Now, let me shift gears here a little bit, and let me talk about the big question we typically get. Okay, yeah, I understand disability. I know it's important, but why would I worry about purchasing now? I'm young and I'm healthy. Why worry about it now? Well, let me give you 3 things to consider here. First and foremost, you are going to be presented with, whether it's through us or through someone else, you are going to be presented with very special offers with minimal eligibility requirements. And you'll never see those offers again after your graduation period and after you complete training. So this window of time that you're in right now as a young physician, you are going to be presented with these special offers, and they will eventually go away. So that's one reason as to why now. The other we talked a little bit about is you're simply going to get better rates when you're young and healthy. And whether you choose to lock those in with a level rate or take advantage of the step rates, either way, you're going to get better rates being young and healthy. So those 2 things, most people tend to say, yeah, okay, I get, I was aware of that. The third one is something you may or may not be aware of. And to me, it's certainly an important consideration, but it's one around timing. And the key here is that you can obtain more overall disability coverage by purchasing individual first. Now, I'm going to give you an example of what I mean by that, but most people don't quite understand this, and they don't take it into consideration when they think about why now. So let's take an example. And the example, I'm going to weave in both a group long-term disability plan that you might get from an employer and an individual plan that you might purchase on your own. We see that a lot. A physician pairs these 2 things to provide enough coverage for their overall income. However, there are these things called participation limits that could govern what you can and can't get from certain carriers in certain situations. So let's go through an example here. So in my example, $200,000 annual income, and let's say in a couple of years that income is projected to increase up to $300,000. Let's then look at what part of that income is insurable. So in other words, an insurance company isn't going to insure the total $200,000, which could incent people to go on claim rather than work. So an insurance company is never going to cover the full amount of your income. They'll offer it up to typically 66 2/3% of your income. So in this example, we define the insurable amount as $133,200. So that's the insurable target, or if you break that down into a monthly target, $11,100. So that's sort of the math that we begin with. Now, let's say you've just completed your training, you've gone into practice. Your new employer is going to provide you with $10,000 of group long-term disability. You also want to apply for your own plan because you know it's portable, you know you could take it with you, you know it can get locked in, you like the idea of a level rate, let's say. So you want both of these. However, an individual plan or an IDI is going to consider two things. One, other coverage you have in place when you apply for their coverage. And so this is where that idea of participation limits comes into play. Or they'll have some sort of dollar amount, I'll call it a cap. You might see 20,000, you might see $20,000. So an insurance company, an individual carrier is going to say, we'll go up to your insurable target and we'll look at all of the different coverages you're participating in to figure out what we're willing to offer, and we'll cap that off at $20,000. So here's an example of what I mean by timing. So let's say this is your scenario, and let's say you elect to obtain the group coverage first. In other words, you go into your new employer, your new practice, you've not purchased any individual coverage. Your employer is giving you that $10,000, and then let's say 6 months later, you decide you want to purchase your own coverage and you want an individual plan. Well, that individual carrier is likely going to look at a participation limit and say, gosh, you already have 10,000 of coverage. Your monthly insurable target, in our example, is 11,100. We're only willing to give you $1,100 of coverage. However, if you flip that around and let's say you buy the $7,500 of individual coverage first, and then 6 months later you become employed and your employer gives you access to their group coverage of $10,000 per participant, that group LTD plan is not going to look at a participation limit. So they'll simply add it. You now are in position to have $17,500 of total coverage. Why is that important, especially for a young physician? Is it allows you to obtain that contract at a higher amount, and it positions you then to grow into it. So in my example, 2 years in, I'm now at $300,000. This total package of about $17,500 in coverage just about is what I need, maybe a little bit more than what I need, but my first example doesn't cover my income. I now have to go back out and reapply and purchase a whole new policy on top of what I already have. So timing does matter. And so any disability agent you speak with, I would encourage you to think about having this kind of conversation. And it's a reason why a lot of physicians ask us, why should I purchase an individual plan now? I'm going to get group coverage from my teaching hospital, from my employer. This is how I would explain that. Okay, let me summarize what's available in the market. And this is a very high level overview just to give you kind of a feel for the types of plans available. By no means is it a detailed comparison, not intended to. But on the left-hand side here, you're going to see group coverage. We've been talking about group LTD. This is a plan that might be offered by your employer, by your school, by your teaching hospital. There are pros and cons to this plan, okay? One off, it is going to be very inexpensive. It's a great way to get a lot of coverage at a very, very low price point. So it's inexpensive, number one. The benefits are likely going to be taxed. If your employer is going to pay for it, it's going to be taxed. Generic to occupation, in many cases, it might not have a specific true own occupation definition. Certainly not portable. It is easy to purchase because there are no underwriting requirements. It could be canceled, the rate could increase, and you can't really customize it, so there's really not a lot of riders that you can select on your own. However, again, it is very inexpensive. In the middle is what we would refer to as an association or affinity group. This is where you know, a group like the AMA, a group like a specialty society that you might join as you continue down your career path. It's groups that create sort of this buying power mentality and leverage sort of a better rate by doing that. And so that buying power is of value. The benefits typically are not taxed because in this sort of a model, this sort of a product, each individual physician is purchasing it on their own with their own income. It can be specific to occupation, so it's a little tighter definition of disability, certainly portable. There are underwriting requirements, so it could be a little more difficult to obtain, but it does have some more flexibility in terms of riders and so forth. And then on the other end of the spectrum is this IDI product, the individual product that I mentioned. Most expensive, but certainly probably, you know, the richest, if you will, of the contracts. It too is not taxed because it's typically paid by the individual physician, specific to occupation, portable, harder to purchase because of the underwriting requirements and so forth. Now, there are pros and cons, as you can see on this slide, for each of these types of plans. In our opinion, there's not a right or wrong or a good or better. They're simply different. And what we see a lot of physicians do, younger and older physicians, is they'll use these plans together and pair them together to create the coverage that they need to protect their income. So again, just something to consider from our standpoint. We're agnostic here. We offer all three. Not everyone does. Some agencies may, but most will either offer one or the other. Okay, so again, just be aware of what's out there. Understand sort of the pros and cons, not good or bad, just, you know, what works for you. Okay, now let me transition here just a little bit and more specifically to what's being presented to you today. And that is this idea of conversion coverage. You are currently covered by LSU. LSU has selected our plan to cover you, but you are currently covered with disability insurance. But when you graduate, that coverage ends, and you're going to kind of be on your own as you move into the next phase of your career. So the idea of conversion coverage is simply this. It helps you take what you had available as a group and convert it into a plan that you can then take with you for the rest of your career. Now, the question that I get is, well, why is that important? Why is that of value? And here's what I would say. There are 4 things that I would encourage you to consider when you're presented with any of these kinds of conversion options. One is there's no underwriting, which means it's very simple and very easy to obtain. Number 2, that timing element that I mentioned, if you purchase the IDI first, then you can typically get more overall coverage earlier in your career. Okay, so there's a timing component. It's portable, and again, the pricing advantages. So there are some interesting benefits here associated with any sort of conversion offer that you're given, whether again it's through us or through someone else. Now, I'm going to wrap up with just a couple slides and give you a feel for what you have available through LSU and the plan that they have with us through this Young Physicians program. Okay, and as we design this, and I will say this is a brand new program, we just introduced it this year, and the goal of this program was to address a couple different things. One, we wanted to make sure it was tailored not to just physicians, but in particular to young physicians. Second, we wanted to make this extremely affordable and then allow you to grow into it throughout your career as your income increases. We also wanted to create something that was extremely simple and easy to obtain and remove what we would call the traditional barriers of purchasing insurance. And then we also wanted to make it easy for you to upgrade, increase coverage, compare and contrast options, and even make some changes to your plan over a period of time. And then lastly, we wanted to provide access to a trusted source, someone you could contact that did not earn a commission on any kind of sale, and help you make an informed decision. So that was our goal with the plan that we were trying to create. And here's what that plan looks like in practice. And this is what you have available to you if it's something that you feel like makes some sense. So first off, LSU has made arrangements for you to have an additional $500 of coverage. You have that now. That is in place on top of what you've already had the last 3.5 years as a medical student. Next, you have an opportunity to take this $500 and convert it into $1,000. We are purposely keeping the benefit amount small to keep the cost very, very affordable. So just for comparison, this $1,000 of coverage generically across the country would cost somewhere in the $162, $163 per year. Okay, that's not a monthly figure, that's an annual figure. If you were to purchase a comparable IDI plan for the same benefit amount, it's likely $500 to $550. Okay, so our goal here was to drive down the price as much as possible, and then allow you to select larger benefit amounts as your income increased, and to do so in a very simplified process. What that means in layman's terms, no medical exams, no blood and urine, no lengthy questionnaires at any point in this process. So you would start with 1,000, and as you began your career, within the first 4 years of your career, you could get all the way up to $17,000 of coverage if you elected. You could certainly stay at the 1,000 if you preferred, up to you. So that's the idea of what we tried to design and what is currently available to you through LSU. And the last thing is this: we tried to design some better benefits. So the contract in this case is going to have a specialty definition. It's portable. You can take it with you. You can actually add riders to this plan, not now, but later, with no medical requirements, no additional blood and urine, no any blood and urine, and no lengthy questionnaires. So not only can you add an increased benefit amount, you can strengthen the coverage by adding these riders. And then lastly, we wanted to provide you with access to these non-commissioned insurance specialists. So you have a dedicated person, I believe it's Joe Bender, who's been assigned to the LSU arrangement, and you can contact him directly with any questions on not just this plan, but any questions you might have on disability in general. So I will stop there. That's really what we wanted to present. We wanted to hopefully give you some things to think about, hopefully give you a few new nuggets around disability insurance, let you know what was available. And then we simply want to open up the rest of the time we have together for questions that anyone might have in the group. And Cassie, I don't know, can you unmute everyone?
It looks like that, yeah, attendees can unmute themselves. I gave them access to be able to do it themselves. I guess if you guys cannot do that, just type it in the chat.
Yeah, type it in the chat. You can, hopefully if you can unmute yourself, feel free to ask any questions. You know, the rest of the time is yours. We're here to answer any questions about this plan you have access to, disability insurance, whatever you'd like to discuss. No, I don't see anything in the chat. Cassie or Jack, do you see anything in the chat?
Nope.
Is
Oh,
there,
wait. Oh, it looked, if you, okay, there are some questions.
Okay.
Wait, can you hear me, Mike?
I can, yes.
Okay. Someone asked, I have a few questions I wanted to just send up front. I'm not sure if you'll answer some of these in the, okay. Okay, wait. Is the AMA Young Physicians Disability Insurance Policy a group or individual policy?
Okay, good question. So remember the slide I showed with the 3 columns, the 3 different types of plans? Our plan is in the middle, so it's on a group chassis, but it's individually purchased, individually underwritten, and works like an individual plan, meaning it's portable. So it is more like a individual plan, even though the structure is built on a group platform.
Okay, and then is it a non-cancelable and guaranteed renewable policy?
It is not. That's a good question. So it is not a non-cancelable product. It is guaranteed renewable. And by way of background, the AMA has had this plan in place for over 50 years. Our agency's been in business for 35 years, but it's a very good question. It could be canceled. Typically what we see to get that non-cancelable feature woven into an individual plan, there's typically a price associated with that, so you'll see premiums go up a little bit. But again, we have access to and we do offer physicians a non-cancelable product. So if that's something that's preferred, we can certainly offer that, but we don't. It's a guaranteed renewable contract.
Okay, and then is the resident physician considered the policy owner?
The resident physician would be considered the certificate holder. Again, the way it works is to leverage the buying power of the American Medical Association. There's a trust established. The policy is issued to the trust. The trust then issues certificates to all of the individuals that participate in it. So the resident would be participating and therefore receive a certificate of coverage from the group policy. Now,
Okay, and
that's the technical speak, but it works in layman's terms. The short answer was yes, you are the owner of your plan, so to speak.
okay, and then does this policy have an own occupation definition of total disability?
Good, that's a great question. So the contract provision that we put in here, again, with the goal of keeping the price as affordable as possible, it utilizes that modified ONOC definition. And then when you complete your residency training, if you remember on the previous slide, I talked about different riders that you could elect to purchase with no additional underwriting requirements. Well, one of the riders that you can purchase upon completion of your training is a true ONOC definition of disability. So you can enhance that definition. It does cost a little more, but our intent was to keep price as low as possible and create options out into practice where income was going to grow, and then add the richer riders and benefits at that point in time. So great question. Great question.
Is there a recovery benefit for this policy?
There is a residual benefit. Yes. Yes.
Okay. So the boxes in the illustration of the AMA policy said subject to a few health questions once finishing residency. Can you explain what that entails, as that sounds like underwriting?
So in other words, there's what's called in underwriting terms, guaranteed standard issue underwriting. You'll hear different people speak to it as GSI versus GI, guaranteed issue. So guaranteed issue is what you were offered with the $500. It's what you have available to you if you want to convert that plan to the $1,000. GSI does have a few what are referred to gatekeeper questions. And those gatekeeper questions tend to reside around, you know, are you on claim now, or are you, I don't recall the specific questions off the top of my head, but it's not a detailed list of health-related questions. There's typically 2 or 3 questions that are intended to basically screen out anybody that might otherwise be on claim. If you're on claim, we're going to continue to pay that, but we don't necessarily want to increase the coverage if we're already paying out a claim. Again, the idea with that is to help keep the price low or lower than it would otherwise be.
Okay, and then follow up to that, by the same person, my understanding is that we will likely be offered guaranteed standard issue IDI policies without underwriting, own occupation, specialty specific. But if we have ever applied for our own policy and have been denied or issued with an exclusion rider for pre-existing conditions or dangerous hobbies, etc., then we lose the guaranteed policy. Can you be denied or issued a rider for this policy, and when does it have to be converted by? I guess that's 2 questions.
So I can't speak to other contracts, but ours, no. That ours has none of those kinds of requirements in there. And so if you were to convert and you were to have the $1,000 of coverage and you took that with you into residency, and let's say at the time you completed residency, you wanted to exercise the provision to increase benefits up to $5,000, and let's say you wanted to add the couple riders that I mentioned, you could do all that. And if you were to apply somewhere else and you were denied, it would not impact anything you're doing with us. I think if I understood the question correctly. Hope I addressed that. If that individual still has some questions around that, please either, if you can speak on the screen or chat, that would be great.
His last question was, when does it have to be converted by?
The window ends on June 30th of this year. So you have from now until June 30th.
And then where would we go to start the process of conversion to the individual policy?
What we'll do is we'll send a follow-up email to everybody that participated on this webinar. We'll also send that to Dr. Lazarus, and you can send it out to the rest of the group. But in that follow-up email, we'll provide a link to the enrollment site where you can apply and convert the coverage. We'll also provide some additional information on there that may answer a couple of questions that, let's say, may not have surfaced in this conversation. So the follow-up email will have the specific link, and you can look at that. And if you have questions, there should be contact info there. So hopefully that will provide what you need.
Okay, we got a couple more. You mentioned that the policy was a modified individual policy under the AMA group plan. Would purchasing this policy work the same as purchasing an individual IDI policy first before purchasing a group policy, such that the coverage would be additive if one were to purchase a group policy later from a hospital group? I'm referring to the math that you did on the participation limit slide.
Okay, I think I understand that. So there's what's called true group or employer group coverage, okay? And so think of that as in its own category. Our group chassis that we use to issue individual certificates of coverage works more like an individual plan. So we would have a participation limit, and an IDI plan would have a participation limit. And so if you purchased an individual plan and then you wanted to purchase ours, or vice versa, both of those would look at participation limits. Either one on their own. With true employer group, the true employer group is not going to look for a participation limit. So I hope that made some sense.
Okay, and then someone asked, could we get a copy of this presentation for our reference?
Yeah, I believe it's been recorded. So we can send that out as a follow-up as well. Absolutely. Be happy to do that.
Okay, wait. With the increase in premium and benefits yearly, what is the renewal process?
There is no renewal process. So once you have the coverage in place, as long as you continue to pay the premiums, the coverage will remain in force. You will be presented with opportunities to increase the coverage amounts or to add riders at certain points in time in your career. Specifically, when you're in residency, you will be offered an annual opportunity to increase the benefit amount by $500 a year, capping at $2,000 while you're in residency. When you finish residency, you'll be presented with an offer for $5,000. None of that has underwriting requirements. There's no renewal requirement. You simply continue to pay the premium. The coverage remains in force. Then 2 years into practice, you'll be presented with another 5,000, so a total of 10. And then within 4 years, if your income justifies, you would be presented all the way up to the $17,000. So it works a little different. True employer group coverage does have renewal provisions. And so it typically, the group has to renew it every year. The rates can change each year. Our plan, an IDI plan, anything you buy on your own individually doesn't typically operate that way. Once it's in place, you continue to pay the premiums, the coverage continues to be provided. Now there is that non-cancelable provision versus the guaranteed renewal provision, but it works differently than what you would consider to be a true employer group, which does an annual review, annual process kind of thing.
Okay, I think that's all the questions so far.
Okay,
hear
those were
me?
great. Those were really good
Oh.
questions.
Oh, wait,
Yeah.
yeah,
Can you hear me?
Yes.
Yeah, hi, it's Dr. Lazarus. Thank you for a great presentation. If you get the information to me, I will send it out to the whole class and I will post the
Sure.
recording on our learning management platform so the students that weren't able to attend will be able to access it. And I will wait to get your detailed email and then I'll send it to all the students. So
Okay,
I just wanted to say thank you. And I thought it was great, really clear. It's my second time hearing it and I still learned something new.
Thank you. Thank you again for the opportunity. I hope the rest of the group found it informative. We're here to help. If you have any questions on anything, you can contact me, contact Jack. We'll provide the contact information for your insurance specialist, Joe Bender. You can contact him directly as well.
okay.
Thank you all so much. Hope you have a good rest of your day.
Thanks, folks.
Bye-bye.